I'm now going to review the topic interest in joint ventures and joint arrangements. This topic is dealt with under IFRS in IFRS 11, joint arrangements. Under ASPE, it's dealt with in a relatively new handbook section. It's not that new any longer, but relatively new section, Handbook 3056, interest in joint ventures. The old section under ASPE was dramatically different than IFRS. The new section is fairly similar. So what I've done is the following. I've summarized each of the two gaps separately. I will go over the IFRS guidance, and I will ask you to look at the ASPE guidance on your own. Given that under the current handbook section, it's fairly similar to IFRS, I think it'll be very easy for you to review the notes on your own for ASPE. So let's take a look at accounting for joint arrangements under IFRS. In a joint arrangement, parties would be bound by a contractual arrangement, so there has to be a contractual arrangement that gives two or more of those parties joint control of the arrangement. So by definition, in a joint arrangement, there has to be joint control. If one party can unilaterally control the arrangement, you're clearly not dealing with a joint arrangement. A contractual arrangement would normally be in writing. Obviously, that doesn't have to be the case from an accounting perspective, but realistically, from a legal perspective, generally it would be put in writing. Otherwise, the other parties would certainly have to trust each other because there'd be nothing in writing to prove anything. So realistically, they would typically be in writing. A joint arrangement can either be a joint operation or it can be a joint venture. We'll see in a few minutes that the accounting is quite different depending on which of these categories a joint arrangement falls into. Let's talk for a moment now about joint control, because that's the essence of a joint arrangement. Without joint control, we don't have a joint arrangement. Joint control is a contractually agreed sharing of control of an arrangement, which exists only when the decisions about the relevant activities require the unanimous consent of the parties sharing control. So, at the end of the day, as I said to you before, if one party can unilaterally control, then we don't require unanimous consent, and therefore we don't have joint control. If one party can unilaterally control, we're typically dealing with a subsidiary. We're not dealing with a joint arrangement. Now, you'll notice that one term that comes up is the term relevant activities. So we're talking about decisions about relevant activities. What exactly are relevant activities? These are activities that significantly affect the returns of the arrangement. And what I've done here is I've just given you examples, could include selling and purchasing of goods, managing of financial assets, etc. These are exactly the same factors that came up in the lecture on consolidations. So if the term relevant activity sounds familiar after you watch the lecture on consolidations, I'm not surprised. What I'd like to do is I'd like to take a look at a couple of examples to demonstrate this notion of joint control. In example number one, let's assume there are three parties. Joint control would exist as long as two or more of the parties control the arrangement collectively. Note that not all three have to, but at least two or more need to. So let's assume the voting rights are as follows. Party A has 50% ownership and 50% of the votes. Party B, 30%. Party C, 20%. Let's assume that the contractual arrangement specifies that at least 75% of the voting rights are required to make decisions about relevant activities. Now, again, the parties to the arrangement could come up with any percentage they like. Let's assume they decided that we're going to require 75% of the votes to make decisions about relevant activities. In this situation, A and B would have joint control, while C would be considered to be participating in the joint venture, but would not have joint control. Now, why is that the case? The reason that's the case is in order to exceed the 75%, we'll always need both A and B to agree. Because if A and C agree to something, that's only 70%. If B and C agree to something, that's only 50%, 30 plus 20. So the only way that decisions can be made is with the consent of A and B. So A and B have joint control. C is not required because once A and B agree, we've got 80% already. We don't need C. And if A and B do not agree on something, then even with C, we don't achieve our 75%. So at the end of the day, C may be a party to this joint arrangement, but C would not be considered to have joint control. They're participating in the joint venture or the joint arrangement, but they would not have joint control. We'll see later on how this affects the accounting. Now I'd like to give you an example of where joint control would not exist. Let's assume there are 5 parties, A, B, C, D, and E. Each one has 20% of the voting rights. And let's assume in this situation, an agreement was reached that you would need a minimum of 60% of the voting rights to make a particular decision. As I said before, the parties to the arrangement could agree on any percentage. In this example, they agreed on 60%. If this 60% of the voting rights can be achieved by more than one combination of parties, so if we can reach the 60% by A, B, and C agreeing, or B, C, and D agreeing, or C, D, and E agreeing, or any permutation of 3 parties, then this would not, from an accounting perspective, be considered a joint arrangement. It would only be a joint arrangement if the contractual arrangement specified which combination of parties, say, for example, A, C, and D, or say, for example, A, B, and C, are required to agree unanimously to a decision about the relevant activities of the arrangement. But if it can be any combination of permutations, then we don't have a joint arrangement. So in this case, it could be any combination of the 3 parties, so we don't have a joint arrangement. Now, I mentioned at the very beginning of the lecture that there are 2 possible classifications for joint arrangement. There are joint operations, and then there are joint ventures. And whether we classify an arrangement as a joint operation or a joint venture really depends upon the rights and obligations of the parties to the arrangement. A joint operation is a joint arrangement where the parties who are referred to as joint operators that have control of the arrangement have rights to the individual assets and obligations, have rights to the individual assets as well as obligations for the individual liabilities relating to the arrangement. A joint venture, on the other hand, is a joint arrangement where the parties that have control of the arrangement only have rights to the net assets of the arrangement. They don't have rights to the individual assets or obligations for the individual liabilities. Now, if a joint venture is not structured through a separate vehicle, say we don't set up a separate entity like a corporation or a partnership to carry on the activities of the joint arrangement, then by definition, we're dealing with a joint arrangement. Is that clear? I hope that's clear to everybody because that's a very, very important concept. The reason this is the case is, think about it. If we don't set up a separate entity to carry on the joint venture, then by definition, each of the parties would by definition have a share in each asset and each liability. Just imagine if I, Michael Levy, do a joint venture with Dick Smith, and basically the 2 of us decide to develop some land. If we don't have a separate entity, we're not setting up a separate entity to carry on the activities of the joint arrangement, then what are we going to do? We'll buy a piece of land. I'll have a percentage share in the land. Dick Smith will. We'll buy machinery. I'll have a share in each. I'll have an X% share in the machinery. Dick Smith will have an X percentage share in the machinery. So at the end of the day, for every asset, and the same will be true if we issue debt, each of us will have a share in the obligation. So if there's no separate entity, then by definition, each party will have a share in each individual asset and a responsibility or obligation for each individual liability. So by definition, you're dealing with a joint operation when there's no separate vehicle. Determining the classification when you do set up a separate vehicle, like a corporation, for example, would require the consideration of various factors. Let's take a look, guys. Say we set up an arrangement through a separate vehicle. When the parties structure a joint arrangement through a separate vehicle, in determining whether we have a joint operation or a joint venture, we need to assess whether the legal structure or legal form of the separate vehicle, the terms of the contractual arrangement, and where relevant, any other facts and circumstances give the parties rights to assets and obligations for the liability relating to the arrangement, in which case we're dealing with a joint operation, or whether the parties only have rights to the net assets. And it's these factors up here that will help us determine that. A basic rule, or very simple rule, that I always work with is as follows. If the assets and liabilities belong to a separate vehicle, say I decide to do a joint venture with Richard Smith, and Richard and I decide to set up a corporation to carry on the activities of the joint venture. So the corporation will buy the assets. The corporation will assume the liabilities. So in this situation, the assets and liabilities belong to the separate vehicle. In my example, a corporation. In this case, the parties, myself and Richard, effectively own an interest in the net assets of the arrangement, the net assets of the corporation. And therefore, we would assume it is a joint venture rather than a joint operation, unless the terms of the contractual arrangement or any other facts and circumstances override this assessment. So I hope people understand this. Once you're dealing with a separate vehicle like a corporation, the default would be joint venture, because the parties, in all likelihood, will only have rights to the net assets as opposed to rights to individual assets, obligations, or individual liabilities. So unless there's reason to believe otherwise, the default would be joint venture. Now, here is an example of where contractual arrangements may override the assessment that the arrangement is a joint venture. Let's say we have two parties, myself and Richard, and we structure a joint arrangement through a corporation. The incorporation enables a separation of the entity from its owners, and as a consequence, as I said a moment ago, the assets and liabilities held in the entity are the assets and liability of the corporation. The corporation owns the assets, the corporation has responsibility for the liabilities. In such a case, as I said a moment ago, our default would be to assess the legal form of the corporation as indicating that the parties have rights to the net assets of the arrangement, and therefore our initial presumption would be, oh, this is probably a joint venture. However, here comes the big however. However, if the parties modify the features of the corporation through their contractual arrangement so that each party will have an interest in the assets of the incorporated entity, and each will be liable for the liabilities of the incorporated entity in specified proportion, probably based on their ownership interest, this modification could cause the arrangement to be considered a joint arrangement. So I just want to make sure that people understand this. Let's say, for example, Richard and I decide to put in place a contract to override the way a corporation would normally work, so that each of us will have a right in the individual assets. And each of us will assume liability, personal liability, for each of the liabilities in the corporation. So we set up a contract to effectively modify the way a corporation would normally work, so that we do have rights to individual assets and obligation of individual liabilities. Because we've overridden the way a corporation normally works, now we have a joint operation rather than a joint venture. And again, I wouldn't assume this would happen very often, because usually the whole reason you're setting up a corporation is because you want limited liability. So it would be rare to override the way a corporation works. However, if two parties chose to do so, or if you have a number of parties involved, if the parties decide to do so, then you could end up with a joint operation, despite the fact that you're working with a corporation. Now, there can also be other facts and circumstances that may indicate that we're dealing with a joint operation rather than a joint venture. Even when the joint arrangement is structured in a separate vehicle, and even if we don't set up contractual terms to override the assessment that the arrangement is a joint venture. So we don't do anything to override the way the legal vehicle is working. We don't do anything to override the way the corporation works. You can still have situations where the entity would still be a joint operation. So what I'm going to give you now is an example of where facts and circumstances would lead me to believe that the arrangement, despite being carried on in a corporation, is still a joint operation. So just to repeat, guys, normally when you have a corporation, you have a joint venture. However, if you override the way it works, the way a corporation normally works, you can end up with a joint operation. Even if you don't override the way a corporation normally works, other facts and circumstances may still indicate that you have a joint operation rather than joint venture. Let's take a look at an example. Let's assume the following. The activities of an arrangement are designed, let's say, for the provision of output to investors. So the investors set up this joint arrangement with the intent that the output will go to them. They will use the output of the joint arrangement. Let's take an example, guys. Let's assume that I run a big bakery operation, and Richard Smith also runs a big bakery operation. So Richard and I set up a corporation with joint control, and the whole purpose of the corporation is to provide, to, let's say, grind wheat into flour that each of us can use in our bakery. So the activities of the arrangement are primarily designed for the provision of output, in this case flour, to each of the investors, myself and Richard. So Richard and I have rights to substantially all of the economic benefits of the assets of the arrangement. And again, it could be that if there's a little bit of surplus flour, we'll sell it to other people, but the primary purpose of the joint arrangement to grind wheat into flour is for ourselves. We will be using the vast majority of the flour that's produced. So effectively, Richard and I have rights to substantially all the economic benefits of the assets of the arrangement. The effect of an arrangement with such a design and purpose is that the liabilities incurred by the arrangement are in substance also satisfied by the cash flows that are received from whom? From Richard and myself, from the investors, through the purchase of our output. So if you think about it, Richard and I are also funding the liabilities because we're purchasing virtually all of the output, and that cash flow is used to extinguish the liabilities. So when the investors are substantially the only source of cash flow, contributing to the continuity of the operation of the arrangement, which is the case here, where we're buying virtually all the flour, this indicates that the two parties, Richard and myself, actually have an obligation for the liabilities relating to the arrangement. That's the only way the liabilities will be paid off, is through Richard and I contributing cash flow to the joint arrangement in return for the flour. So here's a situation where, given that the investors, myself and Richard, have rights to the assets and obligations for the liabilities, at least substantively, at least in substance, therefore we would treat this as a joint operation, even though it's being carried on through a corporation. Now, the question I'm going to address now is, why does it matter so much whether you're dealing with a joint operation or you're dealing with a joint venture? And the answer is, it makes a huge difference. When you have a joint operation, a joint operator recognizes, in relation to its interest in a joint operation, its share of assets, liabilities, revenue, and expenses. So when you're dealing with a joint operation, we use what we used to call proportionate consolidation. That term is no longer in the handbook. Please don't use it. But I'm just using it to explain a concept. With regular consolidation, if A owns B, A would add 100% of A's assets to 100% of B's assets. And then at the bottom of the financial statement, there would be a non-controlling interest that is there to reflect the fact that A may not own 100% of B. But in adding up in coming up with consolidated assets, even if A only owns 60% of B, A would own 100. A would add 100% of its own assets to 100% of B's assets. And the fact that they don't own 40% of the assets, that's taken care of through the non-controlling interest. But when you're accounting for a joint operation, you would simply take the joint operator's own assets and add their share of the assets in the corporation. So if A has a 60% interest in the joint operation, then A would only add 60% of the assets in the joint operation to its own assets, and 60% of the liabilities in the corporation to its own liabilities, and 60% of the revenue and expenses in the joint operation to its own revenue and expenses. That's why they used to refer to this type of accounting as proportional consolidation. But as I said a moment ago, that term is no longer used. Here's a quick example just to drive in the concept. Say you have a joint operator who owns a 60% interest in the joint operation. And in case anybody's wondering, you can own a 60% interest and there can still be joint control. The contract may still stipulate that A is not able to control the operation even though they own 60%. Not unusual to have an uneven breakdown of interest and still have joint control. So you have a joint operator who owns 60% interest in a joint operation. Let's assume the joint operator has land of its own of 100,000, and let's assume that the joint operation has land of 50,000. So if this was regular consolidation, the parent had land of 100K and the sub had land of 50K, we would show $150,000 of land on the consolidated statements. But when we account for a joint operation, we only add the joint operator's proportionate share of the assets in the joint operation. So what we would do here is we would take the 100K of land the joint operator owns, and we would add their share of the land in the joint operation, which is 60% of 50K, and we would show $130,000 of land in the consolidated statements. So when you're accounting for a joint operation, you just pick up the joint operator's proportionate share of each of the assets, liabilities, revenues, and expenses. Now, if one or more parties participate in the joint operation, but doesn't have joint control, in my example that I gave at the very beginning of the lecture, there were three parties, A, B, and C, but you may recall that C was a participant in the joint venture, but C did not have joint control because A and B alone could get enough votes to make decisions. So we didn't really need C. So we said C is a participant in the joint venture without having joint control. So how would C account for its share of the joint arrangement? At the end of the day, if this is a joint operation and C is just a participant without having joint control, the treatment I just discussed, proportionate consolidation, without using that term, would still apply as long as those parties who don't have control still have rights to the assets and obligations or liabilities relating to the operation. So at the end of the day, C may only own a 20% interest in the joint arrangement. If you go back to the example we looked at earlier, C may only be a participant and not have joint control, but as long as C has a right to each of the individual assets and an obligation, so they have a right to 20% of the individual assets and an obligation for 20% of the liabilities, in that situation, C, despite only owning a 20% interest and despite not having joint control, would still add to its own financial statement its share of assets and liabilities, revenues, and expenses. So in my last example, C would still add 20% of the assets, liabilities, revenues, and expenses to their own assets, liabilities, revenues, and expenses, even though they don't have joint control, because they're still a participant in the joint operation. As long as they've got rights to individual assets and obligations for individual liabilities, they would still effectively proportionately consolidate. Now, what about a joint venture? How do you account for a joint venture? Say Richard and I set up a corporation to manage our arrangement, and let's assume we don't override the terms of the corporation and there's no other facts and circumstances indicating otherwise. We would treat this as a joint venture. A joint venturer accounts for its interest in a joint venture as an investment using the equity method, unless the entity is exempted from applying the equity method. And if you look at the notes on accounting for associates equity method, you'll see the rules for exemptions. I'll let you look at the rules on your own. Just please go back to the notes on accounting for associates equity method, and you'll see the rules for exemption. Now, what I'd like to talk about next is accounting for sales of assets to a joint operation or the purchase of assets from a joint operation. Let's start off with accounting for sales or contributions of assets to a joint venture. When an entity sells or contributes assets to a joint operation, it recognizes gains and losses resulting from such a transaction, but only to the extent of the other party's interest in the joint operation. So if A owns a 60% interest, they can only recognize to the 40% of the gain. Let's say they made a gain of $100, they can only recognize 40% of the gain if they own 60%. When there is a loss on the sale and the transaction provides evidence of a reduction in the net realizable value of the assets sold or contributed to the joint operation, or of an impairment loss of those assets, those losses would be recognized fully by the joint operator. Let me give you now an example, because the best way to understand things is always by example. Say you've got a joint operator, and the joint operator owns a 60% interest in a joint operation, and they sell inventory to the joint operations for proceeds of $150,000, and the carrying value is $100,000. So the total profit is $50,000. The joint operator who sold the inventory can only recognize to the extent of the other venturer, which is 40% because they own 60%. So they can recognize $20,000 of gain as long as the inventory is still sitting in the joint operation. When the joint operation then sells the inventory to a third party, at that point they can recognize the remaining portion of the gain, the remaining $30,000. But as long as the inventory is sitting in the joint operation, the joint operator can only recognize to the extent of the other operator's interest. Because the moral of the story is you can't recognize a gain on a sale to yourself. If A owns 60% of the joint operation, 60% of that profit is a profit on a sale to itself. You can't recognize profit on a sale to yourself. You can recognize the other 40% even when the inventory is still in the joint operation, because the other 40% is owned by another party. Now, what about accounting for purchases of assets by a joint operation from a joint operator? When an entity purchases assets from a joint operation, it would not recognize its share of the gains and losses until it resells those assets to a third party. I'm not allowed to pick up my share of income in a joint operation that the joint operation earned on selling something to me. You can't pick up your share of earnings that were earned through an operation that you own a portion of selling to yourself, right? You don't make money selling things to yourself. However, when such a transaction provides evidence of a reduction in net realizable value of the assets to be purchased, or an impairment or of an impairment loss of those assets, then the operator would clearly recognize its share of those losses. Let me give you a good example. Let's assume ABC Inc. owns 60% of a joint operation. Let's assume ABC Inc. purchases goods from the joint operation for $500K, which it plans to sell to a third party. Let's assume the carrying value of the goods in the joint operation is $300,000. So the joint operation sold the goods for $500K to one of its owners, ABC, who owns a 60% interest. They sold the goods for $500K. The cost of goods sold would be $300K. So the joint operation made a profit of $200K. At year end, let's assume the goods have not been sold by ABC and are still in ABC's inventory. So obviously ABC Inc. cannot pick up its share of that $200K profit on a sale to itself. So let's take a look at what would happen over here. And let's assume that the total profit of the joint operation, including the $200,000 of profit that the joint operation made on the sale to ABC, was $1 million. So let's assume that the joint operation made $800,000 of profits from external sales and another $200K on the sale to one of its joint operators, ABC. ABC Inc. is only allowed to recognize 60% of the profits of the joint operation, excluding the profits that the joint operation owned on the sale to ABC. So ABC would be allowed to recognize 60% of the million, less the $200,000 that was earned by the joint operation on a sale to ABC. So effectively, ABC can only pick up their share of the profits on external sales of the joint operation, to external parties, but they can't pick up their share of the $200K. So they would pick up 60% of $800,000, which is $480,000. That's the portion of the profit they would be allowed to pick up. ABC would only be allowed to recognize 60% of the $200K on the sale to itself when they actually sell the goods. When ABC actually sells the goods to a third party, at that point, they would be allowed to recognize the 60% of the $200K. At that point, they could recognize the final $120,000. The final subtopic I'd like to deal with is separate financial statements. As I'm sure you're all aware, under IFRS, separate financial statements are often presented in addition to your statutory statements. So, for example, let's say you had a joint venture. The company might do the company might, in addition to doing statutory statements using the equity method for their joint venture, they might do a separate set of statements for, say, the CRA. And that separate second set of statements, the separate statements are like a second set of statements they're giving to the CRA. They may not want to use the equity method because the equity method has no meaning for tax purposes. There is no such a thing as equity method for tax purposes. So what I'd like to deal with now is, what do you do in a situation where separate financial statements, an additional set of statements, is prepared in addition to the statutory statements? In that situation, how would you account for an investment in a joint venture? So the answer is that in the separate financial statements, depending on the purpose for which they're preparing these separate statements, they could choose to account for the investment at cost. They could treat it as a financial instrument, and I apologize, this should say IFRS 9, not IAS 39. So they could treat it at cost. They could account for it at cost. They could treat it as a financial instrument under IFRS 9, or if it suits them, they could use the equity method. They would have a fair amount of choice. But keep in mind, I'm dealing with the separate statements that are prepared in addition to the consolidated, in addition to the statutory financial statements. The last section, in accounting for acquisition of interest in joint operations, I'm going to ask you to look at on your own. And as I mentioned at the beginning of the lecture, the guidance under ASPE now has been made fairly similar to IFRS. So I will ask you to look at the notes on the ASPE treatment of interest in joint arrangements on your own. This concludes our discussion of accounting for joint arrangements.